Good afternoon and welcome to Markets Today. I'm your host, Odhiambo Ramugi. We are looking at the performance of the market so far. All indications are that the market is recovering. We are in the green. The all share index is in the green. The NSE 20 share index is also in the green. But as you remember, today is a Wednesday, so it's a global markets day, and there is corresponding performance across the globe as the markets picked up also in the green. Well, before we go into the discussions though, let's have a look at how the market performed in terms of the gainers, the losers, and the movers of the day. To top the gainers list, I think, is the Bank of Kigali, did 7.14%, closing the day at, let's see that, at 30 shillings. And followed by Stanbic, which closed the day at 94 shillings, being 7.12% upwards. Williamson Tea equally performed very well, closed the day at 135 shillings, being 3.85% upwards. Liberty Kenya also became a portfolio, a speculator's haven at 6 shillings 84 cents, being 3.32% upwards. ABSA, or what is formerly Barclays Bank, closed the day at 11 shillings 55 cents, being 1.32% upwards, and being the last of the gainers in my list. However, there are other gainers in the market. Let's go to the losers, and the biggest loser today was Home Africa, having shed off 5.26% to close the day at 36 cents. Uchumi supermarkets equally lost ground, closing the day at 22 cents, being 4.35% lower. Everready East Africa is equally in the losers list, closing the day at 94 cents, being 4.08% lower. Standard Group closed the day at 15 shillings, being 3.23% lower. Yesterday it was trading at 15.50. EA Guards closed the day at 13 shillings and 10 cents, being 2.96% lower, and closing the list of the losers. Let's have a look at the movers, the major movers. Here we have the commoners and the new entrants. Equity Group Holdings was the biggest mover, having traded 6.7 million shares. Safaricom PLC did 5.4 million shares. I think those are some very good numbers compared to the previous weeks. The Cooperative Bank, KCB was the third at 1.3 million shares, followed by the Cooperative Bank, which traded 672,000 shares. Kengen Company Limited traded 169,000 shares, being the smallest in the pack. Nonetheless, it has made the list of the major movers of the day. Well, joining us today to have this conversation, I have the senior portfolio analyst from Standard Investment Investment Bank, Mr. Mabinda.
Kahinda.
Mr. Kahinda. Sorry, I'm baptizing you on air. Karibu sana.
Asante.
Thank you very much.
It's a pleasure to be on your show.
Excellent. What do you make of the market movements today?
So I think it's very interesting to see the top gainers today. There we've seen Stanbic Bank 7%, and for a stock of its stature, that's quite a move. However, I'd like to turn attention to what we've seen on the top movers. High volumes on equity, high volumes on Safaricom. We've seen Safaricom over the last 2 weeks had been losing ground quite a bit. It's good to see that we have now started recording foreign inflows back into the counter. This suspected is because of the developments around Ethiopia. So Ethiopia have a freeze on telecom licenses, and investors were concerned that this would affect Safaricom and the M-Pesa license that they're getting, financial services license, right? But Ethiopia earlier in the week said that they shall go ahead and honor their word and issue Safaricom with the license. And because of this, we are seeing a lot of renewed foreign interest into the counter. So that's definitely a vote of confidence into Safaricom, which makes up a large part of our boss.
Of our trade today.
Yeah.
So you feel that there is the Ethiopian effect around
Absolutely.
Okay. And what's pushing Equity Bank up? I saw a report of them being one of the 5 most successful banks globally.
Absolutely. So for Equity Bank, it's purely a strategy-driven bank. Oh, the renewed interest we're seeing, in my opinion, is because of investors coming in to participate in future expected earnings. We've seen a move by them into Congo. Congo is a population of about 90 million people, right? Twice what you have in Kenya.
Yeah, that's
And
big.
if they're able to generate the sort of numbers that they generate out of Kenya, with half the population, you can only imagine the sort of numbers that they'll get out of Congo. So Congo is also very, it is, I would say, where Kenya was quite a number of years ago. There's a lot of opportunity in terms of the proportion of the population that is banked is quite low. So there's a huge opportunity there, right? So,
I mean, the market is underdeveloped, as it were.
I don't know if I would say underdeveloped, but yes, they are right at the beginning of the curve.
Okay.
Yeah.
Doesn't that then portend some potential risks to maybe regulatory risks to Equity Bank in Congo?
It could, correct. But however, as a bank, as a big bank, I'm sure what they have done is they have weighed all these against the potential return. And they've seen these are places where they have been before. When they started out in the country in 1995, thereabouts, we were not too far off from where Congo is right now, right? And the advantage for Congo is it is working on a blueprint that other markets have successfully implemented. So they have a reference point,
Yeah.
right? So you have these big companies that are going in and they're able to influence and say, look, this model has worked elsewhere. There's no need to reinvent the wheel. Just apply this model and you will get yourself to where these guys have gotten themselves within X number of years. So there's a lot of potential, and I think that's what investors are excited about. We've seen a lot of renewed interest into Congo, you know?
Yeah.
So that's exciting for the bank and for the country, I guess.
I mean, it's a stock I'd want to put my eyes on and just see how it performs in the next coming weeks. And I hope we'll have you back here to have a commentary on the same.
Absolutely.
But today, as you remember, our conversation is around the Eurozone and investing in Europe. And I know the Standard Investment Bank is strong on matters global markets.
Correct.
Start us off. Is Europe an attractive investment destination?
Yes, I would say yes. Actually quite attractive compared to, say, the rest of the world. I would look at Europe in various ways. The reason I would consider it attractive is, one, the depth and liquidity of the markets. They're very deep, very liquid. It offers investors opportunities to get in and out at their desired prices without risks of slippage or, you know, some places you'd have to wait for orders to be filled. You'd have to probably fill your orders partially because you're not going to get volume in the order that you want. So it's very deep. But then I think what it has going for it mostly is it's also an extremely mature market, right? It's mature, it's very stable. You rarely hear of systemic stability risks within the European Union or the Eurozone. So these are factors that investors will look at: maturity, stability, depth, ease of investment. One thing that Europe is also very strong on is corporate governance. So because of this, investors have the confidence that the companies in which they're investing in actually report what they say that they're doing. You'll never get 100% assurances, because we've seen even in developed markets, instances of people reporting one thing and then
what is
turning out
happening
that
is another. Yeah.
what's actually happening on the ground is a bit different. But then you have a certain degree of confidence because there's a lot of very solid audits that go on in the background. In addition to these factors, you also have the cost effectiveness. Some markets are extremely expensive to trade in. You know, you have what I would call exorbitant charges going in and going out, right? And for Europe, what we see is very properly managed costs, trading costs.
Okay.
So as a whole, that actually packages Europe as an attractive destination.
Fair enough.
Yeah.
And it makes sense. But then again, you said that it is a mature market.
Yes.
The challenge of mature markets is that it's a very low risk, but also a very low return profile. If you are to go to Europe, for example, what should be my expectation if I were to invest in, say, the London Stock Exchange in a year? What does the return profile look like? Okay.
So with regards to the risk and return profile of mature markets, last year in itself, say, because we are talking about developed markets, in Europe, I would compare Europe to the States in terms of being developed. And what we're seeing is, for instance, the FTSE last year did 3%. No, sorry, that is this year so far.
Year to date?
Yes, year to date.
Okay.
Last year they did 14.5%. That's in London, in the UK.
Yes.
14.5%.
The FTSE 100.
FTSE 100, right? You have your Euro Stocks 50, which did 20%. You have
20%.
Yes, correct.
That is the whole of 2021.
Yes.
That's higher than
20%.
Nairobi.
In fact, it was slightly above 20%. It was, I think, 20.45%.
That's higher than Nairobi.
Absolutely. So, which we will now bring us back to your risk-reward statement. So we also have S&P, which is, I mean, arguably, the States is the most developed country market-wise. It did north of 26% last year. And you have the biggest economy in the Eurozone as it is now, which is Germany. The DAX index did 16% last year, right? So in terms of a risk-reward, if you compare that to, say, our market, and you adjust this for inflation, right, you see you're still getting a better risk-adjusted return in these developed markets that are, said to have
very low risk and low return.
Yeah. So it is essentially a factor of capital chasing returns and stability, right? Because what you have, again, during times of uncertainty is there's a flight to safety. And developed markets offer safety.
And they enjoy investments at that time, at a time like that.
That's correct.
What opportunities are present in some of these markets for an investor like myself, assuming I'm an investor?
Okay. So opportunities abound, right? Depending on the type of investor you are and the type of return you're looking for. Currently, what we have, sectors that have been doing very well in Europe, and not just in Europe actually, globally. Number one off the top of my head would be energy. Energy is, it's on a tear. Yeah, the whole of last year, the whole of this year, oil prices, it's been going up, and not just oil. You have your natural gas, right? So energy is a very good place to invest in as a sector. You have within Europe luxury goods. Those performed very well, especially over the last 2 years. You have fast-moving consumer goods, FMCG. Those are good, doing well. Industrial, specifically manufacturing, your vehicle sales, your high-tech goods manufacturing, production in Germany. Those are sectors that are doing well. A sector also that, a subsector within energy, renewable energy, doing very well. Europe is probably the biggest proponent of renewable energy currently. And last year, for the first time, the portion of the energy needs and use that was generated from renewable sources exceeded that was the generated from fossil sources.
Interesting.
Absolutely. 38% of the energy they used in 2021 was renewable energy, compared to 37% fossil fuel, which, again, that's for the Eurozone as a whole. Individually, there are some countries that are doing very good. I mean, like Finland is north of 95% renewable energy. Yeah, I think last I checked, about 98%, and that's not dependent on oil. You know, so as a sector, renewable energy for me would be very attractive in Europe, especially because they're also pushing quite a bit in that regard. I mean, as you would be aware, there are conversations that have been going around about decarbonizing.
Yes.
Right, and decarbonizing. So basically, essentially, what this entails is they developed a carbon market back in 2005, where for a company to continue to produce using fossil fuels or methods that are harmful to the environment,
and they have to buy carbon credits.
Exactly. And the cost of those carbon credits for the first time has gone above $95 per credit. You know, it's reaching to the €100 per credit. Sorry, 100 euros. Yeah. That's.
I know it's considerable. Yeah. I think for me, the question in my mind when you are talking about energy, I was just running in my mind: do Europe have any oil? I know the major oil companies are European, the likes of Total, the likes of Shell. But do they have oil really?
So what happens with a lot of these oil companies is they will aggregate their oil from the largest oil producers. Currently in the world globally, the largest oil producers, you have the Americas, you have the oil in Canada, in North America as well, and you have the Asias or the Eastern Europe, basically the Arab energy money, right? So that's where a lot of these companies will get their oil from, aggregate it and export it, process it.
But they are listed in Europe.
Yes.
So I can still get the chunk of the benefit there.
Yeah, the benefit, because you see a lot with energy, the benefit is in the value chain, value addition along the value chain, right?
Not necessarily the producing.
No. Well, the producing has a huge benefit if you manage it well. This always brings up the comparison of, say, Saudi Arabia and Nigeria, both oil producers, right? Probably both people or both countries that are doing different things with their oil fortunes, right? Which brings into the question countries that discover oil, what model are they going to adopt, and will that be beneficial to the economy going forward? There's some countries around us that have recently discovered oil deposits, so that's something I'm sure that is in discussions. Right.
I think we used to call it the curse of oil.
That's exactly what it is called. But I don't. It's basically in the mentality.
And not just oil. I think it's more of the curse of the mineral commodities.
Yeah. But then that begs the question: if it really is a commodity producer curse, why does it seem to happen in one part of the world and not in the other parts? You know.
Yeah, I hear you.
It's a conversation
for another
day.
Have
another time.
What risks are there if, for example, I decide to go European and put my money somewhere in Germany or London or Le Français?
Bonjour, merci. So, so the risks that are specific to Europe. So let me first start with the global risks, right? The risks that are facing investors right now, regardless of where you are, is one, policy risk, because of two, inflationary risks, right? So inflationary risks, because of the COVID pandemic management measures, are spread across the region. And because everyone is concerned about inflation right now, there's a huge conversation around central bank action across the globe.
Yeah.
Right. We already have the UK that has started us off with a rate hike, 25 basis points. There has been talk recently of, actually not talk, but the ECB president, Madam Christine Lagarde, came out last week and gave a speech in which she sounded very different from what she had sounded previously with regards to monetary policy, right? You're seeing markets...
Change of stance.
Oh, yes. Oh, yes. And these things happen. When the situation changes, when data... So the data that they were working with previously led to them being very accommodative,
yeah,
and very, sure that they will not need to take any action this year in terms of hiking rates. But things change.
Certainly.
And the economic transmission mechanism sometimes takes time to actually show the effect that policy has had on the economy down on the ground.
Yeah.
Right? So
by the time the data comes, some time has gone.
Exactly. And that's expected. It's generally known. So there's always allowances for that. So this is why we see that a lot of these policymakers will always maintain some flexibility around their action and what they say they'll do. And even when they say something, they do not commit to a specific number and time.
Yeah.
Because, again, things change.
All right. So from what I hear, you foresee policy risks in Europe significantly. No significant political risks. And, of course, the worst of COVID is past us, behind us. Any other risks I'm leaving out?
Yeah. Take us back to the risks. I had completely
deviated.
It happens when conversation is quite interesting.
Yes.
So other risks I would look at when looking at Europe are supply chain risks. These are still as a result, side effects of the pandemic, right? It caused supply chain disruptions all over the world. And if you're going to go into Europe, I mentioned earlier that some of the biggest companies are manufacturing opportunities we see there, but then these are affected by supply chain risks because a lot of these manufacturing companies, as an input, will need, say for instance, chips, right, which come from China, which is not shipping, right? So if they're not shipping, these guys are not able to produce, and if they're not able to produce, they're not able to meet their profit targets, and the investor is not able to realize the return that they had gone in for. So that remains a risk. We also still have, for the Eurozone as a whole, and this is a very personal risk, is a block risk, right? We are seeing a lot of new, or if not new, but more emboldened conversations around exiting the bloc, right? So we have a portion of the French population that is Eurosceptic. We have a portion of the Italian population that's Eurosceptic. We had in 2016, Britain vote to leave the EU. It's the first country to leave the EU in the 47 years that the EU has been in existence in one form or another, set off as the European Commission. And that was very unexpected. So they voted 2016, actual exit 2020. So we are seeing a lot of, it has emboldened a lot of conversations around those who are skeptical of the bloc. So that remains a bit of a distant risk, but a bit of a risk. And this is because if we have a lot more exits from the bloc, So how the block works is you have this commission, and then the member countries contribute to the block, and then that sort of supports the block. If you have some major donors exiting, you leave
less contributions.
Yes, and
smaller economy.
And an equally big budget. So you'll have basically one person supporting a large,
yeah.
and which again risks not the euro in itself. But then that's a very distant risk.
Yeah.
Yeah. So the more immediate ones are the ones we've just spoken about.
Okay.
Yeah.
Fair enough. Mr. Mabinda has given me a tongue twister that there are chips from China that needs to be shipped. And this is disrupting the supply chain in Europe. On that note of chips, and I believe it's microchips and not these chips of French fries.
Yes. Microchips.
We'll take a break, and then when we come back, we'll talk more about the investment in Europe. But the opportunities are there. When you come back, we'll hear more about it.